Welcome to Lorde Finance, where we are dedicated to helping you achieve financial freedom through education. You start a series of activities when your alarm goes off in the morning, getting ready, making coffee, and leaving for work. Your work may not even be finished when you go to bed that night. With so much going on, it's simple to overlook the greater accomplishments you make, such as home purchases or debt repayments. Here are 11 financial achievements to be thrilled about right now, whether you've already crossed them off your list or believe you will in the near future. Number 1. Your first paycheck. Your path to financial freedom begins with your first paycheck, whether it comes from a part-time work, full-time work or just babysitting. With the use of your knowledge and abilities, you have produced value. You can use that formula again and again, enlarging it each time. You may learn a lot about how to spend money by working for a living. You had to work for that money, and because of that, you may be more careful with your purchasing decisions. For instance, you may buy a new clothing and a nice dinner with your income. Given that you need to put in 40 hours of additional effort to replace that money, you might reconsider. Number 2. Your first retirement fund contribution. Whether you're saving for retirement in a 401k, IRA, investment account, or all the above, your first retirement contribution is a big deal. Because it will be invested for a longer period of time than subsequent contributions, that initial deposit has the greatest growth potential of any future contributions you make. Your retirement savings plan's timetable is also established by your initial contribution. You'll have a long timeline if you start saving early. This translates to more growth potential and increased freedom to make riskier investments. If you start saving later, you'll need to make higher contributions to accomplish the same financial objective. As you get closer to retirement, you might also need to invest more cautiously to reduce volatility. Number 3. Buying your first home. There are various causes to rejoice when you purchase your first house. For starters, you undoubtedly had to make some savings to make it happen. And the roof you're building for yourself deserves to be appreciated. Furthermore, if you decide to finance the purchase with a standard mortgage, the principal and interest component of your payment should remain constant for 30 years. This protects you from rising rent. Your asset's value rises as you pay off the mortgage and the value of the house rises. By downsizing, refinancing, or obtaining a reverse mortgage, you can access that value. Alternatively, you might just relax and enjoy your later years without having to worry about mortgage payments. Number 4. Setting up your emergency fund. The amount in your emergency fund should be enough to cover your living expenditures for 3 to 6 months, according to experts. It can take 10 years or more of consistent cash savings account contributions to reach that objective. When you have a sizable emergency fund, you are well protected from unforeseen financial calamities including job loss, medical emergencies, vehicle accidents, and litigation. You can withdraw funds from your cash account to handle these emergencies rather than using a credit card or 401k loan. After the withdrawal, you'll need to resume your cash deposits, but that's a better conclusion than years of credit card interest or having to start over with your retirement savings. Number 5. Reaching 15% contributions to your retirement. Generally speaking, by saving and investing 15% of your income for the most of your career, you can maintain your lifestyle in retirement. But in practice, most of us struggle and have to work up to reach a 15% contribution rate. If you are currently unable to reach 15%, make plans to gradually increase your percentage until you do. Use a compound interest calculator to predict your savings growth until retirement once you reach a 15% contribution rate. That will show you if you need to continue raising your contribution rate for the time being or if you're on track to accomplish your savings target with the 15% contribution rate going ahead. Number 6. Paying off your credit card debt. We talk about credit cards and credit card debt a lot on this channel, so it's no surprise it made it on this list. The issue is the continuing, high APR interest rates coupled with the lax repayment restrictions. Up until it is fully repaid, the balance you carry over from month to month continues to incur interest charges. The price of the things you purchased with a credit card goes up as a result. Your monthly spending budget is also impacted by the ongoing interest accrual. If you've ever paid off a big debt, you already know that doing so is an accomplishment. The interest expense machine is turned off and cash flow is made available for other uses by bringing that amount to zero. Number 7. Achieving your retirement savings goal. One of the more difficult financial milestones in life is reaching a target balance in retirement savings. To get there, it may take years of deliberate financial decisions. The initial challenge is to continually save, no matter what. The second is to put those savings into investments and maintain them over time. One of the more effective steps you can do to accumulate wealth is to continue investing. Your returns are likely to be significantly smaller if you often enter and exit the stock market. This occurs as a result of investors' natural tendency to move with the market, which involves selling stocks when their prices are low and buying them when they are high. If you stay invested, on the other hand, you take advantage of the market's long-term growth trends. Those trends, averaging about 7% annual growth after inflation, can go a long way to helping you retire comfortably. Number 8. Paying off your mortgage. You might not be in a rush to reduce your sum because mortgages are currently historically affordable. Owning a property nonetheless comes with a lot of comfort, free and clear. Your retirement budget may also vary dramatically if you don't have a mortgage to pay. Refinancing on a regular basis is a mistake that might make it impossible to pay off a mortgage. It may make sense to refinance for a cheaper interest rate. Nevertheless, refinancing at the same interest rate for a lower payment might not. Frequently, the only reason the payment can be cheaper is because the refinance lengthens the loan's term. If you refinance into a 30-year mortgage with 25 years of payments remaining, your payoff period is extended by 5 years. Number 9. Retiring. Last on the list is the last stretch. It's both exciting and terrifying to submit your last resignation in person. You've been working and saving for years, and now you can choose how you want to spend your time. On the other side, you might not know exactly how your money will pan out from day one. Inflation, healthcare costs, and income taxes are 3 financial wildcards for retirees. You can take action to get ready for these unforeseen circumstances if you're still working. By contributing to a Roth IRA or converting an existing Roth IRA, you can give yourself tax flexibility. If you are eligible, contribute to a health savings account, HSA, for medical expenses. Contributions to the HSA are tax deductible, and withdrawals for medical costs are tax-free. We hope that you feel like you can celebrate your own milestones and enjoy life as it comes.